you find out that the the partners they might decided to admit a new partner. The partnership they might say one of the partners might decided to leave the firm. So at the end of the day, this can rise to the assets to be revalued because we have got what to call, if you look how do you measure our assets and liabilities. We have got a historical cost. A historical cost, that is the amount which we used when we acquire our assets. That is the historical cost. But sometimes we have got a current value which can be determined by the market value, what the willing buyer and the willing seller when they agree to make a transaction, then they can be able to come up with the amount to determine the amount which is supposed to be paid by the buyer. Then you can use maybe value news, what an asset is going to the cash inflow, which is going to flow to the entity, which is going to be generated by that asset. So we can use many ways of revaluing our assets. Okay, so what we need to understand here, we need to understand to explain why there may be a need of revaluation of assets in partnership. That is very critical. We need to understand also calculate the amount of asset revaluation gain or loss attributable to each partner to make the necessary entries to the ledger account when assets are revalued. Then again, what we should understand here, we need to understand other key points which are very, very critical. Why do we need revaluation? That is critical. Why do we need revaluation? Revaluation, usually we are now just carrying an assessment. That's why I said we can use the market value of that asset, the current price or value news, other than maybe the historical cost. The historical cost, that is the amount which was used, the purchase consideration when the asset was acquired. Then when a business is sold and sale price of the asset differs from their book values, there will be a profit or a loss on that business. That is, the profit or loss will be shared between the partners in their profit and loss sharing ratios. So if you sell an asset, that is means you should what? You should sell in the what? In the profit and loss ratio. That is very critical. Then this sharing of profit and losses on change in asset values doesn't just need to be done when a partnership is sold. You don't just wake up early in the morning, then you just carry out that process. So that process, what you need to do, you need to carry out some comprehensive steps, some steps which are considerably good for the business. Then it should also done maybe when the valuation of assets can be done. One, the partnership is admitted. For example, maybe there were 3 partners, then you want to admit a new partner. When you are admitting a new partner, what that partner wanted to find out the value of the assets, the amount which has been invested by the existing company, existing partners, how much they've invested in that company. That is very critical in that firm, so that maybe the new partner, the new investor want to invest his or her money can be able to know the state of the company, the state of the organization. So they should revalue those assets. When a partner leaves a firm, when you want to leave, both want to share the remaining assets, to share maybe the profits which are available, the assets which are available. The partnership change profit sharing ratios. If you change the profit sharing ratio again, might need this. So we have got a three circumstances here whereby we might need to what to revalue our assets. That is when a new partner, for example, our partners, maybe there were two, maybe admitting the third one or the fourth one. Those, so we need to revalue our assets. One who decided to leave the firm again, then we change profit and loss sharing ratio. So we look on examples. For example, here for 3.2, if the revaluation show no difference in asset value, no further action is needed. For example, you might find out that the current amount of those assets are equal to the revalued amount. So it means if there is like that, the new and the old value of assets are similar. There's no need to take further action. That is very critical. For example, here, a new total valuation of assets 90,000, or total valuation of assets that is 60,000. Gain on revaluation 30,000. This one, it means the new total on valuation was 90, then all total valuation was 6. So this one becomes a gain, which means that the action should be taken. We should now open the journal entry because there is a movement, the benefit of third. So we should very take care of the third here. Then if new, let's say the new total valuation of asset is 40, the old total, so it means there was a loss on revaluation because our assets value decreased by 10,000. So one day is a loss of there's a loss of 10,000. So when you go on to the next one, so how do we account for this in our books? Because usually we should understand that our assets, they carry a debt, they are a debt balance. Then our revaluation, usually this is part of the equity. They carry a credit balance. So when you at the asset, if the asset is gained value, to debt the asset. For each asset shown a gain on revaluation, debt that asset. Because when the assets are increased, we debt it. Then you create the valuation account. The revaluation account is part of the is in the equity, under equity. Then the debit, then the assets are under non-current assets. When there is a loss, mean there's a decrease. When there's a decrease in revaluation, decrease in the value of the assets, you debit the revaluation. That is the opposite of this. Then after you've debited the revaluation, you credit the asset account with loss. Then if there is an increase in total valuation of assets, that is the debt profit, if debt profits to revaluation account. If there is an increase in total valuation of assets, debt profit to revaluation account, then you credit all partners capital accounts in all profits and loss. You need to be very careful, very careful on this one. That is all profit account. So we need to be very careful on this one. Say this one, you need to create all partners capital accounts in all profit and loss sharing ratios. 4, if there is a fall in total valuation of assets, maybe there is a fall in total valuation of assets, the debt owed partners capital accounts in old profit sharing ratio, and you credit loss to revaluation account because there's a loss to their revaluation what account. That's why we are supposed to do that. Any question before we go further? Any question before we proceed so that we work together? Okay, if there is no any question, I can be allowed to continue to the practical question. Then here I need somebody to read for us.
Sorry,
Anyone
sir,
to read? Yes, you can read for
I
us.
have a question.
Exhibit 43.1.
No, on the previous task,
Yes, okay, yes.
I wanted to ask the difference between a fall in total valuation of assets and a loss in revaluation of assets.
And we're saying when in our assets they increase their value. For
Yeah.
example, let's say here there was a gain on revaluation, which means that is an increase, a rise in what? In revaluation.
Okay.
But here on loss is a fall because the old valuation is now less than the new one. So use the current one because maybe we are admitting somebody, maybe want a new investor. Saying a new investor want to find out the current state of the assets, the current value of our assets. So that's we got a 4 year. Are we together?
Yes, thank you.
Because when there is a fall in revaluation, which means that the revaluation account also is going to decrease. Any other questions? There's no question because we don't have much time because we want people to save their Wi-Fi, their data. So we can go to the next one. Who can read exhibit 43.1? Any volunteer?
Yes.
Yes, you can continue.
Following Exhibit 43.1, following is the balance sheet as at 31 December 2015 of W and Y, who shared profits and losses in the ratios W 2/3, Y 1/3. From January 2016, the profit and loss sharing ratio is to be altered to W 1/2 and Y 1/2. Balance sheet as at 31 December 2015. The assets were revalued on 1 January 2016 to be premises $90,000, equipment $11,000. Other assets values were unchanged. Accounts to show the assets at revalued amounts show. Then we have the revaluation account.
Okay, hello. Okay, so what you are saying, they shared profit on 2/3, 1/3. There were two. That is their old profit sharing ratio. Like what we say to say we should use their old profit what ratios. When we said when in when one of our partner maybe want to leave or maybe want to admit the other one. So if we are revaluing our assets, we should use what the old profit, the old sharing what ratio, profit sharing ratio. So these are their assets: stock points, debtors 12, bank 8, premises 65, less depreciation 15. So which means that this is our current what? This is our current value of equipment. That is equipment at cost less depreciation. That is 80,000. This is our fixed asset, non-current assets. This one is at cost. This one at cost less depreciation. Be very careful on this one. So it means this one is a net book value, and this one we are not given the depreciation. The assets were revalued on 2006 to be premise 90,000, equipment 11,000. Other assets values were unchanged. So premise 90,000, here is 65. So what was the increase or decrease? Hello, class?
25.
25,000. That was our what? Our increase, our revalue. Then equipment. Here we've got equipment 15,000. And here our equipment is 11,000. So there was a decrease or increase.
4,000. Decrease.
4,000
Decrease.
increase or decrease?
Decrease.
That is a decrease. Then our other assets were not changed. So if the other assets were not changed, like we come up again to here, where they are saying if the revaluation show no difference in asset values, no further action is needed. So here, no further action is needed for other assets. So the only affected assets are these two. So we should take care of these two. Then we go on to our revaluation account. Our revaluation account, we said it has got a credit balance. So if the asset is going up, we credit the revaluation account. That is asset increase in value premise, that's 25,000. But for the asset which increase in value, we debit. Asset reduced in value 4,000. That is the equipment. Then this one, they will share the balancing figure. Gain on revaluation carried capital accounts, 25,000 minus 4,000, which gives us 21,000. And this should be shared using the old profit and sharing and loss sharing ratio, which was 2/3 for Y, 2/3 for Y, and 1/3 W 2/3, sorry, Y 1/3. So 2/3 of 21, that gives us 214, and 1/3 of 21, that is 7. So this one they share. Then when you are going to our premise account, for the premise account, our asset has got a debt balance. So the balance brought down was 65,000. The revaluation increased 25. The balance carried down 9. This is the account, the ledger account. Then on equipment, the balance brought down 15. Then revaluation reduction was 4,000. Was 15 minus 11, that is 4. Balance carried down is now 11. Then the capital account, because here we have got the capital which were given here, W 70, Y 50. So those assets, these values, these two values here, they are going to affect our capital account. So when you are coming to our capital accounts, it's now like this. W, balance carried down. Remember, our capital accounts also, they've got a credit balance. The balance brought down, that is 70,000. Then the revaluation of share of gain, that's 14,000, which means that WC capital has been increased by 14,000 after revaluation. Then for Y, again, that is the balance brought down, that was 50,000. The revaluation share 7,000. Then the balance carried down 57,000, which means that the increase in revaluation, it affected the capital of those partner. Why? Because there was an increase. Such an increase, it increased their what? Their capital accounts. Any question before we go to the next round, the next level? Any question, class? Any question? Or yeah? Any question? Any question before we move? Okay, if there is no any question, let's go on. The next. So what we need to do, we need to get ourselves ready for other activities. We need to look on these review questions. They are very important. We should look on the review questions like this one. You are required to show all the ledger necessary to record the revaluation, drawn up a balance sheet as at January 2006. So you need to do some of these questions at a comfort of what? At a comfort of your home. So that at least you benefit. So that at least you practice on your own. What was going to happen if we had a loss here, let's say on this situation, there was a loss. What happened if there was a loss? Who can explain? Maybe there was a decrease in the revaluation of assets. What was going to happen to the capital account of the partners? What was going to happen? What was going to happen? Let's say, for example, there was a decrease in the value of the assets. Hello? What was going to happen to their capital accounts? Let's say there was a loss in revaluation.
No reduce our capital.
Yes, very good. It reduces our what? Our capital. So it's not always that. Sometimes it's not always the same to say our we should always create the capital account. Sometimes we can end up the capital account if there is a loss in the revaluation. So we need to understand that. That is very critical for us to have a knowledge on that. Okay, let me I'll temporarily remove this slides at the moment, this book, so that at least I'll share with you a slide. Okay, are you seeing the slide there? Hello? Hello, class? Hello? Hello? Hey, Joeline, are you see the slide?
No.
No.
Yes. Alipaoneki.
Eh,
Now you can see it. Right.
Okay. Can you admit your friend, please? I've admitted about 10 at the same time, which means that you are not admitting your colleagues. If somebody is on the loop, may please try to admit that person. Okay, if you are seeing the slide, that's correct. That's good. Let's just look on other examples here. Let's talk about example 1.
Hello, say,
Hello?
say, my inini pa screen pangu pari blank
All right.
and
Vamwe parise
andisikuona bhuku ramuri kushandisa.
ndakushandisa PowerPoint. Ko vamwe parise
Tikupaona.
saka inetwork.
tiri kupaona.
All right.
Because
So
ndikubvira taratanga lecture haisi
unenge
kuonesa
wakuita
chinhu.
ka. Don't worry, kana usingaoni, it might be network. Your network inenge da network pamwe yakati strong. I will share with you. I'm
Alright.
recording this lecture, so you just listen. Then after maybe the lecture, you can able to download the MP4.
Okay, thank you.
Because no gonna get any network. Network can get up lower. Inenge for transmission of waves. Okay.
Alright.
Who can read example 1?
Yes, sir.
Yes, can continue.
A and B are partners in a general partnership. They share the net income on a ratio of 2:3. Partner C is to be admitted to the partnership for an interest of 1/3 in capital and 25% of net income. Before admission, the partners had the following capital balance. Partner under capital, we have A 30,000, B 90,000. Partner C will present the following assets: cash 10,000, building 30,000. The partners agree that the capital after admission will be 180,000. Required, prepare the journal entry record the admission of party C using the goodwill method.
Okay, thank you so much. Thank you so much for the contribution. They share the net income on the ratio of 2:3. Net income, these words, we are talking about either profit or loss. That's net income. Then 2:3, partner C is to be admitted to the partnership for an interest of 1/3 in capital and 25% of net income for the, like what we said, we can do a revaluation of assets because we are now admitting new partners. That's why we are now looking at these examples. Partner C will present the following assets: cash 10,000, building 10,000. The partners agreed that the capital after admission will be 180,000. Then they want the journal entries. So partner A partner B, partner C, paid in capital after admission. Partner A, 30,000, partner B, 90,000, partner C, 40,000, total 160,000. Then capital after admission, here they are saying the partner after admission, here they are saying before admitting, they've got 30,000 for A, B 90,000, partner C will present, so 10 plus 30, that is give us 40, this will give us 40,000 here. So you should include both cash and assets invested, they form a capital. Be very careful on this one. So you need to be very careful. Both you need to add both the cash and the building, both they form the what? They form the capital. Don't pick cash only. You can invest, if you invest your asset in the business, they form a capital. If you invest your vehicle or a building or invest in asset which is going to be used in generating revenues in that particular business, automatically this one, it becomes what? It forms your capital. So you need to be very careful on this one. That's why here we have got 40,000 paid in capital. We have got 40,000. Then we have got what? 160 what? Thousand. That is the total what? Capital. That is paid in capital. Then you want to find out what was the revaluation of our assets after that. Then they said the partners agreed that the capital after admission will be 180,000, which means that there is an increase here. The increase, that is 180,000. That is, there was what? There was an increase here to 160,000, 180,000. What does this mean? Which means that 180 minus 160, go back to the previous lesson. This is raises to our what we call a goodwill, because the fair value of our assets is 160,000, but the purchase consideration is now 180,000. So which means that 180,000 minus 160,000 becomes 20,000. That forms a what? A goodwill. That forms a goodwill. And the goodwill here, because we are a new partner, we are saying our business maybe have got a reputation, then this one likely to affect that 20,000 or affect what? The partner C. So the partner C is going to pay an extra what? 20,000. That is 40 plus 20, which is 60,000 after admission. These ones, they will not pay 90 plus 60, because this one is bringing you what? It becomes a good two. Then the total in capital, that is 160,000, is less than total capital after admission of 180,000. So there is goodwill, like what we did in the previous lecture, that if the fair value of our assets is less than the amount which is going to be paid, the purchase consideration, that rises to goodwill. The paid in capital for new partner 40,000, less than share in the capital after admission, that is 6,000 equal to 180,000 multiplied by 1 page. So there is a goodwill of 20,000 and it belongs to the new partner. Belongs to the new partner. Why the sharing ratio here they are saying they are sharing 2:3 to be admitted 1:3. Partner C is to be admitted to the partnership for an interest of 1/3 in capital and 25% of net income. 25% will get 25%, which is 1/4, but 1/3 in what? In capital. So this person should invest 1/3 of the total capital. You need to understand this one. So it means 1/3 in capital. So the capital is now 180. So it's 1/3 of 180 for C, which brings us to 60. Because it's now 1/3 of 180. That is 60. That's the capital to be invested here. So that's why here our partner is got what? 60 what? Our new partner 60,000. That is share in the capital after admission. So cash 10,000. If you are doing a ledger, even a general entry, to debt the cash, building and goodwill. Goodwill is an asset, 20,000. Then the capital C, 60,000. Any question before we move? Any question? Because C is responsible for contributing 1/3 of the capital. So 1/3 of the capital after admission is 1/8. So that's why we have got 6,000. Any question before we go on to the next slide? Any question? If you don't have any question, let's go on to example 2. Who can read example 2 for us? Example 2. Hello, who can read example 2?
Yes, sir.
Yes, you can continue. You guys here are not admitting your friends. Just click the green button, the green tick.
A and B are partners in a general partnership. They share the net income on a ratio of 2:3. Partner C is to be admitted to the partnership for an interest of 1/3 in capital and 25% of net income. Before admission, the partners had the following capital balance. Under A, there's 30,000 and B, 60,000. Partner C will present cash 50,000. The partners agreed that the capital after admission will be 150,000. Prepare the journal entry to record the admission of Part C using the goodwill method.
The goodwill method. Okay. So before the capital, if we add 30 plus 50 plus 50, what do you get? Plus 6 plus 50 plus what do you get?
140,000.
140,000, correct? And what is the capital? The goodwill there. Is there a goodwill?
Yes.
Or no goodwill?
10,000.
Hello?
We have a 10,000 goodwill.
There's a goodwill.
Yes.
Okay. Okay, thank you. There's a goodwill. Then, if there's a goodwill, how do we record it? What we do here, we are saying partner A paid in capital 30, partner B 60, partner C 50. Total 140. But they are saying C is responsible for 1/3. You come back here, 1/3 in capital. Interest on capital, which means that is going to benefit, that is 1/3 and 25% of net income. So what we mean here, 1/3 of 150,000, which is 50,000 here, or it remains 50,000. Then here there is a 10,000 here. So the total paid capital 140,000 is less than total capital for admission 150,000. So there's a goodwill. The paid in capital for the new partner 55,000 in his share in the capital for admission, it remains the same. That is 1/3 of 150,000. So the goodwill 10,000 belong to the old partners. Be very careful on this one, because he has got 1/3. 1/3 of 150 is 50. 50 minus 50 is 0. On the previous person, capital after admission was higher. That's why the goodwill was belonging to the new partner. But in these circumstances, in this scenario, the scenario here, it means the 10,000 is for old partners. So the old partner will share the 10,000 using the old profit and loss sharing ratio. They share. So here, what was their old? It was 2:3. 2:3, it means 2 plus 3, which is 5. So it's 2/5 and 3/5. This is simple mathematics. I don't think anyone will have a problem in this one. So 2/3, they use the odd ratio because it belongs to them. After 1/3 of 150, then 1/3 of 150, we have got 50,000, which means that the new partner paid 50,000. 50,000 minus 50,000 equates to 0, which means that the remaining goodwill is for the old partners. So the old partners will now say 2/3 of 10, 2/5 of 10, and 3/5 of 10. That is what you're supposed to do. So it's 4,000 and 6,000. So A's capital after admission is equal to 30,000 plus 4,000, which is 34,000. Capital after admission is 6,000 plus 6,000, which is 6,000 plus, which is 6,000. So because the goodwill it belongs to them, then the cash 50,000, go to 10,000 when you are doing the journal entries. Then the capital C 50,000, capital A 4,000, capital B 6,000. As shares in, because we debt the goodwill of 10,000 because it's an asset. So on the admission of the partner, we have got the cash of 50,000, the goodwill of 10,000, then the capital C of 50,000. Then this goodwill was shared because when there is an increase in capital, we credit the capital account. So their capital accounts are going to be credited by this, but represented by the goodwill in the assets. Any area which needs clarification there? Any area which needs clarification? Any area which needs clarification before we move to the next? Hello, class. So I can proceed. Are you allowing me to proceed? Hello. Are you allowing me to proceed?
Yes, sir.
Okay.
Okay, let me proceed if you are together. Then you go on to the example 3 again. Who can read the example 3? Who can read for us example 3?
Yes, sir.
Yes, can continue reading.
A and B are partners in a general partnership. They share the net income on a ratio of 2:3. Partner C is to be admitted to the partnership for an interest of 25% in capital and the net income before admission. The partners have the following capital balance. Capital A, 40,000, B, 80,000. Partner C will present cash 50,000. Required, prepare the journal entry to record the admission of partner C using the bonus method.
Okay, thank you so much. Thank you for bringing that. Let's try to find out the key elements here. So the bonus method. So what do we do? The capital, that is 40 plus 80, that is 120,000 plus the 50,000, which was presented by C. So now we have got 170,000. That is the amount which we have now at the moment. Then prepare the journal entry to record the admission of partner C's in the bonus method. So paid in capital 40, 80, 150, 170,000. Then what is the contribution? Partner C's to be admitted to the partnership in the interest of 25% on capital. So it means it's liable of 25% of the total capital interest which is going to receive. So 25% of 170,000. That is the figure here. 170,000 times 25%, which is 42,500. But he is paid 50,000. But the capital is now less by 50,000. So what does it mean? So when we use the bonus method, it means that the total paid in capital must equal to the total capital after admission. So it equals 270,000. The paid in capital for a new partner, 50,000, should be greater than his share in the capital after admission, which is 42,500. So there is a bonus of 7,500 to the old partner. So the old partner, they will share the what, because he is entitled only for 2,500. So the difference between 50,000 and 42,500, this rises to the bonus of 50 minus 42,500, which is 7,500 here. So the 7,500, that is the bonus to be shared by this capital at their old profit ratio. The old profit ratio 2 to 3, which is 2/5 for A and 3/5 for B here. So at the end of the day, we have got 3,000, 4,500. So their capital after admission, again, it will increase A's capital 6,000 from plus 3, 70,000 plus 4,500. Then when you are going to the journal entry, there's a cash debit, the cash 1,000, which was brought by the new partner. Then the capital of new partner was 42,500. Then capital A, 3,000. Capital B, 45,000. 4,500, sorry. Okay. Then can go again, I think, to the next level, example 4. Who can read example 4 for us? That's the last example. Who can read for us?
Yes, sir.
Yes, can read.
A and B are partners in a general partnership. They share the net income on a ratio of 2:3. Partner C is to be admitted to the partnership for an interest of 1/3 in capital and 25% of net income. Before admission, the partners had the following capital balances. Under A, there's 40,000, and under B, there's 80,000. Partner C will present cash 30,000. Prepare the journal entry to record the admission of party C using the bonus method.
Okay, the same thing is now easier for us because we've done a lot of examples. That is 40 plus 80. That is here cash 30,000. That is 40 plus 80, 120 plus 30. 40 plus 80, 120 plus 30. That is 150,000. Is entitled to 25%. So 25% of 150. That is 37,000. What? I think 37,500. So when you come here, find out that the 50, 70, 30, 150, then the partner capital after admission, that is he is entitled to 1/3, sorry. So if 1/3 means 1/3 of 160,000, that is 50,000. So here it's equal 50 and 50. There is no increase, there is no bonus, there is no goodwill. 150 and 150. So at the end of the day, what does it means? Because this one 150, 150, but here is now more capital admission is now 50, is greater than what? The 30,000, since he is entitled to 1/3. So that is, which means that the new partner C is a beneficiary of this event. Is beneficiary. But what happened is that this should reduce the capital of A and B. It reduces the capital of A and B basing on their old profit and loss sharing ratio. So that is the idea. That is what we agree. So here we've got 550,000. This is 30 minus 50, which is 20. So 2/5 of 20 and 3/5 of 20. This rises to 8,000 and 12,000. So A, that is 50,000 minus 8,000. B, 70 minus 12, that's 58,000. Those are their new capital. The general entry, that is 38 and 12. So they are gaining from the what? From the capital of A and B, get 50,000. 50,000 remain like that. But it affected because there was a what? The partner C, the paid in capital was less than the capital after admission. So which means that this should affect the existing partner. Okay, any questions? Any questions? Hello, class. Any questions?
No, continue.
Okay, what we are going to do, we're going to next we'll take just a small break of about 5 minutes. So let's meet at 10 past 10, whereby we'll be looking on the dissolution of partnership. dissolution of partnership. So let's meet at 10 past 10. Don't log out. Sometimes if you log out, it might be very difficult to be admitted because of our network problems and so on.